So I've been buying HIMS stock since it was $6-7 a share, and I've been talking about it for a while, and I just want to go over the great quarter that they had. I really think this is an amazing business, but today I don't want to really go over too much about how the business works or anything. I just want to look at the Q2 numbers because I thought they were really incredible. And you can see that the revenue is up 52% year over year. Net income is from negative $7 million to $13 million. Adjusted EBITDA, operating cash flow, free cash flow, all up triple digits. From the 10 million to 47 million. Absolutely insane. Subscribers up over 40%. So we basically beat all the expectations, and management's given guidance, and we absolutely smashed the guidance. So it's another quarter since 2020. We've just been smashing guidance, smashing quarter analyst estimates. We've been keep on beating them. So taking a look at the balance sheet over here, we have a little over about $230 million of straight cash and short-term investments, and we have some other stuff like goodwill and property. But taking a look at that, that's over $230 million of cash, and the total liabilities altogether $118 million. So this is absolutely incredible. The cash on hand is over double the total liabilities, so no problems whatsoever with the cash balance. Company's extremely healthy. One of the things that I did notice was that the marketing expense did go up quite a bit, but that's normal. I've been talking about this before, how the marketing expense is going to go up a lot since we're growing so much. They're spending a lot on marketing, doing these ads, trying to get a lot more customers, and that's how they're growing their subscribers, 40%, which is really unprecedented because it's pretty hard to grow your subscribers 40% when you have, almost 2 million of them now. You can see the shares outstanding also did go up a decent amount, and that's pretty normal. This company did just recently produce positive free cash flow. Net income is recently positive as well. So, you are going to see a little bit of dilution in the sense that they're going to be giving out that stock-based compensation. So you can see that stock-based compensation being reflected over there. And 24 million, we can take it, that's about half of their free cash flow. And normally I'd say that's crazy, that's way too much. But, this company's growing 40-50%. Their free cash flow is going to grow high double digits, triple digits maybe. So this is totally okay in the short term. I expect once the company, gets larger and stabilizes more, that number is going to stay relatively constant. Okay, just looking at a little bit more of the things that happened, you can see that the company planned to close a $31 million deal to buy that compounding pharmacy. And that's kind of one of the reasons I like him so much, because it goes away from all the bureaucratic nature of kind of how health insurance works. And in America, you have like the pharmacies in one hand, you got to go to the doctor. It's a very multi-step process, and I've talked about this on Twitter about how there's multiple different industries within the medical chain that you have to go through. But for more minor things, whether it be ED, the GLP stuff, which I'm not really going to talk about too much, you kind of have this whole hierarchy of infrastructure in one online app, and you don't have to go through all the bureaucracy of filing insurance and doing all that, because that's included with your HIMS subscription. If we take a look at the numbers over here, I made a post before about how I made a model, and I was assuming that revenue was growing maybe 30 to 40% in the next couple of years, and a lot of people said I was being way too outrageous with that revenue growth. But if we go back and look at the revenue growth, this is actually EPS I'm showing you right over here. But if we go and look at the revenue growth, I'm going to pull up the revenue growth right over here, and I'm going to put the percentage. We can see that, from 2019, 2020, 80% revenue growth. 2021, 82% revenue growth. 2022, 93% revenue growth. And obviously it's going to slow down. You can't go that much forever. 65, 44. 44 is expected this year, and we've been beating that, so it's probably going to be high 40s or 50% for the fiscal year. Analysts are predicting for 25 it's going to be 28, 30%, and then 20% for 2026. But just to reiterate, if you look at these last couple of years, we've been absolutely destroying quarter over quarter the revenue estimates and the EPS estimates, and that doesn't necessarily mean we're going to do the same in the future. But I'm just trying to show you that it's not that far-fetched to assume that HIMS is going to keep growing, 35, 30%, at least in the next 2 years, right? Doesn't necessarily have to slow down that fast, but it could. But I'm just saying, we've been beating analyst estimates. Management has been giving guidance that they've sandbagged every single quarter, so it's not far-fetched to say we can keep growing 35, 30% in the next year or two. If we look at the EPS, we can see that analysts say we're going to have a GAAP EPS of 0.18. We're going to beat that. I mean, we had just 0.5 and then 0.4 in the first quarter. So I expect it to be, probably in the 0.25, low 0.20s. And keep in mind, a lot of this is going to be lower because we have all those expenses, and we have all those expenses. We've had all those shares that are being issued. So that's going to keep the, EPS down a little bit. But, in the long term, we're going to really grow that EPS a lot as the earnings potential get higher. So I just really want to show you kind of what this could potentially look like. And I'm going to bring this over here so you guys can see it. But if you take a look at HIMS, if the GAAP EPS this year, 0.25, the fiscal year 25 and 26, actually I took from analyst estimates. And I'm pretty sure we're going to beat this because we always beat analyst estimates. But let's just use the analyst estimates. Could be wrong, could be lower. Let's just use them, right? So we have GAAP EPS of 0.34 and 0.49 in 26. At $18 a share, we're around $4 billion in market cap. And I'm going to assume, this year we have like $88 million in stock-based compensation. It's going to go up to, let's say, $140 million in 26, right? Kind of in line with what's been going on, maybe even a little on the high side. So, we get I estimated this year if we'll have like a free cash flow of like 160 to 170 million. And then I compounded that by 30%, which I actually think is quite low because I think the free cash flow is going to start exploding as they start gaining their, the subscriber per customer. You saw that it went $53 per subscriber to $57, and as the margins, tend to get better because of this, I really think this is going to get up, and that gives us, with that free cash flow, it gives us 23 EV to free cash flow, using enterprise value because I'm rewarding HIMS for the fact that they have a lot more cash than debt. And if we're using that free cash flow for 26, that's 11 times free cash flow, price to free cash flow. I'm not including stock-based compensation in this, assessment, but that can just give you an idea of how, HIMS is not necessarily expensive here. We're growing 40-50%. For 26, for a PE of like say, in the 20s, or a free cash flow to EV of 11, this is really not that expensive of a business at all. And I'm just talking about the numbers of it. I'm not talking about, I'm not talking about the potential earnings in the future or anything. And I'm not talking about if, let's say, they lower their marketing expense, it could be a lot better. So I think HIMS is really just a really great buy, even at this price right here. We've been buying since $6-7, but even at $18, it does not look expensive at all.